Hi, my name is Ilan Colette, Institutional Portfolio Manager on the GAA team here at Fidelity. It's important we discuss the proposed tariffs coming from the US on Canadian exports. Anything, any significant tariff would push Canada into a recession or would very likely push Canada into recession. Canada is already in a fairly vulnerable state. We've had very little growth since the start of 2023. We have households that are far more indebted than they should be, and that debt is intersecting borrowing rates that is going to be renewing at a higher rate than where it originated. And the tariff risk, in our view, really just presents an additional layer of exposure to the downside that Canada can't really afford to weather at this moment. Now, there's a lot of uncertainty. We don't know when, how, where, or even if these tariffs will occur. But it's something we should be thinking about, and we are, and we're positioned for the potential downside. Again, we've had a fairly cautious view on Canada for some time now, and a lot of that is expressed through a meaningful underweight to the Canadian dollar. One of the ways that we build in resilience into our portfolios is by being underweight the Canadian dollar. In the event of a Canadian dollar depreciation, which we've certainly seen lately, our portfolios get hurt less and we preserve basis points for our end investors. Again, a really critical position and way that we can build in some downside protection and a shock absorber into our portfolios. So one of the things we need to talk about is right now we are optimistic and overweight equities, specifically in the US. Oftentimes, we talk about the downside protection that we have in our funds, right? And the cautious view that we have around Canada and the protection that we're building in with our underweight to the Canadian dollar. But we shouldn't forget that right now we are optimistic and overweight, particularly in the US equity market. What we're witnessing in the US, in our view, is perhaps a two or three times in our lifetime productivity expansion, right? This is something we discussed a long time ago and we're positioned for last year, but we're seeing very strong rates of growth, slowing inflation, a Fed that's normalizing, a healthy labor market, and really strong equity returns. And if we layer on an additional layer of deregulation and sort of pro-growth policies, we expect this to really continue. And we're positioned for it accordingly. We're overweight US equities, and we've broadened that allocation to include more of the equity market rather than just the large cap equities. In other parts of the world, we're a little bit more cautious, right? So again, a protectionist approach may have, well, will certainly have important implications for overseas markets and as well as Canada, where again we're more cautious and defensive in Canada and much more muted positions overseas. So that overweight to equities really is focused in the U.S. And again, we're optimistic and we're meaningfully overweight equities. Um, and if you have any other questions or you want to dig into more of these questions in even more detail, please check out our Q1 thought leadership paper titled 11 Questions into 2025, available now on fidelity.ca. Thanks for watching.